I turned $8,000 into $47,000 in 4 months, and then I lost almost all of it in 11 days. I was 26. Working a regular job. Putting away a little each month. Then a guy in a Discord server showed me his options trading portfolio. Up 600% in 6 weeks. I started watching his calls. They worked. Every single one. So I moved my entire emergency fund into a brokerage account and followed his next trade. First week, I doubled my money. Then tripled it. I thought I'd figured something out that most people never figure out. So I went bigger. I took out a personal loan. $12,000. Put it all in on one trade. The position opened. It looked perfect. Then the market moved in a way I didn't understand. My account started dropping. Fast. I told myself it would bounce back. It didn't. By the time I finally closed the position, I had lost $41,000. Some of it savings. Some of it borrowed money. And I made every single decision completely convinced I was doing the right thing. Today I'm going to show you exactly how that happens, because the same pattern has destroyed a lot of people. And most of them never saw it coming either. So I'm staring at my screen. The position is down 22% and it's only been 40 minutes since the market opened. I remember the feeling exactly. It wasn't panic yet. It was something closer to disbelief. Like watching your car roll into a lake in slow motion and still thinking, maybe it'll stop. The trade was on a tech ETF options contract. A call option expiring in 5 days. The Discord guy, his handle was something like Alpha Capital, had posted the play the night before with a long breakdown of why it was a guaranteed setup. High volume. Earnings catalyst. Institutional buying signals. I had screenshot the whole thing. I'd done the same trade 3 times before with him. Made money every time. So when it started dropping, I thought, he's been right every single time. This is just volatility. Just noise. It'll recover. It dropped another 9%. I added to my position. That's the move, right? Buy the dip. Lower your cost basis. That's what people say. It dropped 18% more in the next 2 hours. Now I was starting to feel it in my chest. That tight, cold feeling. I opened the Discord. He'd already posted an update, shaking out weak hands. Diamond grip. This hits EOD. 47 people had reacted with rocket emojis. I held. By 3 p.m. the contract had lost 71% of its value. I had $9,200 left from a $32,000 position. At 3:45 I sold. Hands shaking. Couldn't look at the number properly for about 10 minutes. And here's the thing that still gets me when I think back on it. I was angry at the market. I was angry at the Discord guy. I spent 2 days convinced the trade had been correct and I'd just gotten unlucky. It took me weeks to understand what had actually happened to me, and it wasn't bad luck. What happened to me was called the Hot Hand Fallacy. Here's what that means in plain language: when something works several times in a row. Your brain starts to believe that winning streak is evidence of skill or of a pattern, even when each event is completely independent. Basketball players experience it. Gamblers experience it. Investors experience it constantly. The Discord guy had made 6 winning calls in a row. That felt like proof he knew something. In reality, with enough people making random calls in a market, some of them will have 6 win streaks just by chance. I had no way to distinguish a lucky streak from genuine skill, and I never even thought to ask. I moved borrowed money based on a streak. That's what cost me $41,000. That story is about following someone else's confidence. But the next one is about something different. It's about what happens when you can't let go of a mistake you've already made. Marcus was 34 when he bought his first rental property. He'd saved for 6 years. Bought a 2-bedroom in a city he'd read was up and coming. The numbers on paper looked solid. $1,400 a month in rent, mortgage of $980, positive cash flow from day one. 3 months in, the tenant stopped paying. Eviction took 4 months in his state. He lost $5,600 in unpaid rent. Then the tenant left the place trashed. Repairs cost another $3,800. He was $9,400 in the hole before he'd even had a full year. Most people at that point would take stock. Maybe hire a property manager. Maybe sell and move on. Marcus did neither. He told himself, "I've already put 6 years of savings into this. I've already lost almost 10 grand. If I quit now, that all meant nothing. So I have to keep going. He bought a second property. Same city. Similar price point. He stretched his credit to do it. His thinking was, scale up, spread the risk, make the numbers work across 2 units instead of 1. Within 8 months, he had 2 problem tenants, $22,000 in combined losses, and a credit score that had dropped 90 points. He came to a financial counselor not asking how to exit. He came asking how to buy a third property. She told me, that was the moment she knew exactly what she was dealing with. That pattern has a name, the sunk cost fallacy. Here's what it means. A sunk cost is money or time you've already spent and cannot get back. The rational move, the one that actually serves your future, is to ignore sunk costs when making new decisions. What's gone is gone. Only the future matters. But human brains don't work that way. We feel the weight of what we've already invested. Walking away feels like admitting it was all wasted. So instead of cutting losses, we double down. We throw good money after bad, trying to justify the original decision. Marcus wasn't making real estate decisions anymore. He was making ego protection decisions. The counselor helped him sell both properties at a loss, clear his credit, and start rebuilding from zero. He told her it felt like a failure. She told him it was the first rational financial decision he'd made in 3 years. Marcus's mistake was about the past. He couldn't let go of money already spent. The next story is about the future, and how believing you can predict it gets people into serious trouble. In 2021, Priya worked in tech. She was good with numbers. She had been watching crypto since 2017 and had made a modest investment that returned well. When her friends started talking about a specific altcoin in early 2021, she wasn't someone who didn't know what she was doing. She felt like she understood this space. The coin had gone from $0.003 to 11 cents in 3 months. Everyone in her group chat was sending screenshots. Someone had turned $400 into $14,000. Another person had gone in with $2,000 and was sitting at $60,000 on paper. Priya did her research. She read the white paper. She looked at the development team's GitHub activity. She read 3 articles about the project. All 3 articles were written by people who held the coin. She put in $18,000. That was about 40% of her liquid savings. The coin peaked 2 weeks later. She didn't sell because everyone in the group chat said it was going to $1. The charts looked like it was just getting started. Then it started sliding. 20% down. Then 40%. The group chat stayed confident. Just a correction, hold tight, the fundamentals are still strong. At 60% down, people started going quiet. At 80% down, the group chat basically died. Priya sold at a 74% loss. $13,320 gone. What made her tell me the story, months later, wasn't the money. It was something she'd realized about how she'd made the decision. She said, I did the research. I thought I knew what I was doing. And somehow that made me more reckless, not less. She was right. And that exact thing has a name. It's called the Dunning-Kruger Effect. Specifically, it describes how a small amount of knowledge can create an outsized sense of confidence. You learn enough to feel competent but not enough to understand what you don't know. That gap, between your confidence level and your actual knowledge level, is exactly where the most expensive mistakes happen. Priya wasn't unintelligent. She wasn't reckless by nature. She just hit that dangerous middle zone where she knew more than a complete beginner but far less than someone who'd actually seen markets collapse before. She read 3 articles. They all confirmed what she already wanted to believe. She didn't look for reasons not to buy. She looked for reasons to justify a decision she'd already emotionally made. The research wasn't due diligence. It was decoration. 3 people. 3 completely different situations. But the same thread running through all of them, a brain that was absolutely convinced it was making the right call, right up until it wasn't. The Hot Hand Fallacy. The Sunk Cost Fallacy. The Dunning-Kruger Effect. These aren't obscure psychology terms. They're the actual mechanics behind the most common financial mistakes people make. And knowing the names isn't enough. You have to learn to catch yourself in the moment, which is the hardest part. Here's what I want you to do. Drop in the comments which one of these you've experienced. You don't have to share numbers. Just the pattern. Because I guarantee you're not alone. And if you want to see how these same psychological traps show up in completely different contexts, job decisions, relationships, business. That video is up next.